10,000 is just a nice round figure that was likely to be reached. And remember, at the time when we started with gold and silver, gold was around $300. Now, 10,000 gold in silver terms, if we take the historical ratio of 15, that is 15 times the silver price is the gold price, or the gold price divided by 15 is the silver price. So 10,000 gold divided by 15, which is the historical ratio, as I said, that means $666 for silver.
Global production of gold is only going up by, 2% a year. Yes, we're finding new gold mines, and at higher prices, some gold mines, or some gold deposits that we know about become economic, but it's difficult to ramp that production increase up very, very rapidly. I think we've got over the phase where people with gold, especially if it was their dad's gold and they inherited it, but we're getting over the phase where people are saying, oh my gosh, is it really 4,000? Let me get rid of that quickly.
The projection of gold reaching the $10,000 milestone is not just a psychological target, but a realistic reflection of historical monetary ratios and current supply constraints. When gold was trading near the $300 mark, predicting such levels seemed ambitious, yet the mathematical reality of fiat debasement makes this round figure increasingly inevitable. If we apply the historical 15-to-1 monetary ratio to this $10,000 gold target, the implied price for silver stands at a staggering $666 per ounce. This upside potential is further supported by the fundamental reality that global gold production is only expanding by approximately 2% annually. While higher market valuations can transform previously unprofitable deposits into economic assets, scaling up mining operations is a notoriously slow and capital-intensive process that cannot rapidly alleviate supply deficits. Egon von Greyerz, a globally recognized financial expert and wealth preservation specialist, is joined by AdrianDay, a seasoned portfolio manager and authority in resource investing. Together, they analyze the shifting psychology of the precious metals market, noting that the initial phase of retail investors hastily selling inherited gold at early resistance levels like $4,000 is officially coming to an end. Investors are now recognizing the enduring value of physical metals as long-term wealth preservation assets, rather than quick speculative trades. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We are in a secular bull trend for precious metals and for commodities. That means that the financial system, and especially the monetary system, is in a secular downtrend. As we know, measured in gold, almost all currencies have gone down by 99% since 1971. We're looking at the risk and the direction, which means that you have to now hold gold and silver to protect yourself from the last catastrophic fall of the currency system in this era. Coming back to forecasting prices, I just know that the currencies will collapse and the gold and silver will continue to reflect that over the next few years, just like they've had throughout history. I showed in a recent video the gold price for a cow. I said before, you shouldn't measure gold in dollars or euros. You should measure it really in chickens or cows. So I produced a chart. What is the price of a cow in gold? And if we look back 5,000 years, you can see on this chart here that the price of a cow has gone between half an ounce and 1 ounce of gold for 5,000 years. I mean, that is quite remarkable. It proves the point that it's totally useless to measure anything in a currency like dollars or yen or euros that is going down by the day. And now, of course, we are in the acceleration phase of the debasement of the currencies. It's not a forecast, but it's an interesting way to look at gold and silver. Now, I said when we started with gold in a major way just under 25 years ago, I said that gold will reach $10,000. That wasn't a forecast or a target. It's just, you know, that when you come to the end of the monetary era, the acceleration will take place of the currency debasement, and therefore gold will reflect that. So 10,000 is just a nice round figure that was likely to be reached. And remember, at the time when we started with gold and silver, gold was around $300 we bought gold at in a major way in 2002, and silver was around $4, I think, at the time. So we've now seen a massive growth to $5,000 in the gold price and similar in the silver price. But this is just the start of the acceleration of the precious metals for the simple reason that, as I said, the way we measure it is going to go down by at least the same amount, if not even faster. Now, so what does that mean in relation to the $10,000 gold price? Well, it means that we are very likely to reach it, and I think probably a lot higher, because final phases of the debasement of currencies, as we saw in the Weimar Republic, for example, is very rapid. Now, 10,000 gold in silver terms, if we take the historical ratio of 15, that is 15 times the silver price is the gold price, or the gold price divided by 15 is the silver price. So 10,000 gold divided by 15, which is the historical ratio, as I said, that means $666 for silver. Now, some people are superstitious and don't like the 666. I'm not superstitious. 666 is just a good number. It probably is a lucky number if you are a silver holder. We will see a lot higher prices in gold and silver measured in today's money. Now, I could easily see the gold-silver ratio not stopping at 15, but going down to 10 or lower, because in these final phases of a move, prices normally accelerate a lot further than the norm, if you want. The norm is the historical norm of 15 of the ratio. We could see still lower gold-silver ratio, and therefore silver price, which accelerates much faster than gold. But remember, it also corrects very fast the other way, which we just saw at the end of January when all the metals corrected. But that was a correction, what we saw at the end of January. We're still in the bull phase. I expect this to last in this cycle. In the short term or medium term cycle, I expect that to last another few months, whether that's 4 months or 6 months or whatever, to a lot higher levels. And then we might see at some point a pause for a while until the long-term trend continues for, could be a couple of years, it could be 5 years, it could be 7 years. It doesn't matter. You know that the risk is there, and therefore you have to hold gold and silver in physical form. So there are many factors that will drive this gold and silver price and the debasement of the currencies. Now, obviously, like George Bernard Shaw, we must not trust governments, because the governments are, without fail, always destroy the currency. And we are now, as I said, in the final era of this monetary system, going from $35 an ounce in 1971 to $5,000 today, and to 10,000 and probably a lot higher in the next few years. Now, Shaw said, you have to choose between trusting to the natural stability of gold and the natural stability of the honesty and intelligence of the members of the government. And with due respect to these gentlemen, I advise you, as long as the capitalist system lasts, to vote for gold. Really, what Shaw said is that don't trust governments, don't trust what they say, look at what they do. And the consequence of what they do has been throughout history that they destroy the value of the fiat system. And therefore, you have to hold gold and you have to hold silver in physical form and store it outside the banking system in safe jurisdictions. And obviously, you have to have direct access to your metals also. We are, as I have explained many times, we are at the end of not just a monetary era, but with that end of monetary era, it means that inflation will be accelerating and the whole commodity market will reflect that, because we're going to go now from paper assets to real assets. So we will see major falls in stock markets and bond markets and many other bubble asset classes. And commodities in general will reflect the inflation we're going to see. Now, obviously, gold and silver stocks will benefit greatly from this move, and many of them move up a lot faster than the physical metal. But we have to remember that holding the stocks is another level of risk and not pure wealth preservation. Because holding the stocks means that you're holding it within the financial system. Banks or asset managers are custodians of this gold and silver, and therefore if something happens to the system, you're not going to be certain if you actually get hold of your gold and silver, and you're not certain what they have done with your shares, if they have pledged them, etc.
We are navigating a secular bull trend for precious metals, directly mirroring the catastrophic downtrend of the global fiat system. Since 1971, major currencies have lost 99% of their purchasing power, and this debasement is rapidly accelerating. As we approach the end of this monetary era, gold is projected to reach the $10,000 milestone, accurately reflecting the rapid destruction of fiat value. Using the historical 15-to-1 ratio, this places silver at a target of $666 per ounce, with the potential to surge higher if the ratio compresses further during the final phases of this cycle. To survive this historic wealth transfer from paper to real assets, investors must secure physical gold and silver. Relying on mining stocks introduces dangerous counterparty risks within a fragile banking system. True wealth preservation demands storing physical metals outside traditional financial institutions. Let's get back to the interview.
For a lot of reasons, when you look at market, first of all, gold cycles tend to be long anyway. Historically, they tend to be long. Since the US came off the gold standard in 71, they've been, 10 years on average. You think of 1970 to 1980, or 1971 to 1980, 2001 to 2011. And so, depending on where you say this bull market started, and it didn't really get going until 2022, 2023, I think we've got a lot more to go. That would be just one sign. Two other signs, if I may, and that's the dynamic of the buyers. I'm not going to say this time is different, but you've got the main buyers now, the central banks, and also Tether, whose influence I think has been underappreciated, underestimated. You've got two major buyers who are price insensitive. I won't say completely agnostic, but certainly price is not the main reason that they decide to buy gold on any given day. And Tether, as you know, bought more gold last year than any other any central bank. So they're a meaningful player. This is not just something on the margin. And I think for both of those buyers, they have good reasons, which we can get into if you want, but they both have good reasons to continue to be buyers, and they are price agnostic or largely price agnostic. And then, of course, the other thing is, offsetting that is we still don't really have huge retail participation, or generalist participation, I should say. That's a better way of putting it. Generalist, whether they're retail or whether they're small funds or even big funds. We don't have a lot of generalist participation. And so I don't think this bull market is going to end just as 2011 was the top and 1980 was the top. We're not going to get another top until we have very broad retail, very broad generalist participation, as well as, speculative, manic retail participation. And we're not there yet. Look, if you look at central banks, everybody knows that they're diversifying away from the dollar in the face of, concentration in a single asset. At the beginning of the century, 2001 or 2000, it was like 78% of central bank foreign reserves were in the dollar. So moving away from extreme concentration in a single asset, an asset that's owned by a profligate government, which is willing to use its dominance and its power to weaponize the dollar. This has been going on for 25 years. I mentioned in 2000 it was 78%. As recently or far away, I should say, as 5 years ago, it had already fallen to 65% of share of central bank foreign reserves in the dollar. So this is a long-standing thing. It's not just a long-standing move. It's not just something that's happened, in the last year since Trump took over. And of course, the big spark was the confiscation of Russian central bank assets. And that's what really exacerbated the move. But it's a move that's been going on a long time. Here's a question I think I said is nothing that started under Trump, but I think it's also fair to say that nothing that the US administration has done in the last 13 months, 14 months, has assuaged the concerns either on the weaponization or indeed on the profligacy of this government. And this isn't a Republican or Democrat thing, unfortunately. Unfortunately, I say unfortunately because it would be nice if you actually had one party in Washington that actually believed in fiscal discipline, whether their party was in office or not, but that doesn't seem to be the case. Obviously, there's some individuals, are an exception. And so the question I would pose is, if you're a central bank that's worried about the profligacy of the US government that not only is not getting any better, but is actually getting worse, everything that happens, it's just getting worse. And then even, forget the DHS shutdown, but even this latest budget agreement between the two houses actually increased spending. It increased spending for the education department, which was meant to be abolished. So how's that going if you're increasing the budget? So profligacy is increasing, and then the weaponization is increasing. And if you're concerned about those two things, and you've got 48% of your assets in the dollar, is 48% still too high? I mean, I would argue yes. Now, it depends whether you're Britain or Germany or, you know, someone maybe with a little more to be concerned about from the US, but I would argue that having basically half your assets in the dollar is still too much. The global production of gold is only going up by, what, 2% a year. And yes, we're finding new gold mines, and at higher prices, some gold mines, you know, or some gold deposits that we know about become economic. But it's difficult to ramp that production increase up very, very rapidly. And so the question is, people who already own, the more important question is, people who already own gold, what's the incentive for them to sell gold? And I think as gold continues to move up, I think we've got over the phase which we saw for most of 2024 and all of 2024 and most of 2025. I think we've got over the phase where people with gold, especially if it was their dad's gold and they inherited it, but we're getting over the phase where people are saying, oh my gosh, is it really 4,000? Let me get rid of that quickly. I think we're now past that phase, and so the question is, at what point do people decide that they want to sell their gold? In the current global environment, fiscal, monetary, geopolitical, and everything else, I think people are going to be reluctant to sell their gold. Grant Williams, who you know, had a good commentary on that, where he said, listen, at the moment, the gold I have would buy a reasonable house, but not a particularly good house in a good location in Sydney, Australia, where he wants to buy a house and retire, I think. He said 5 years ago he would have bought me a shack in the suburbs. Maybe at some point it'll buy me a really nice house on the waterfront overlooking the harbour, and I might say, okay, I'd rather have the house than the gold. And different people, of course, will have different, you know, they'll reach that threshold or that equation, you know, at different times, obviously. But again, I think we're over the point where people are saying, oh my gosh, gold at 4,000, let's dump it, let's raise the cash.
The current precious metals bull cycle has a long runway ahead, considering historical cycles typically last an average of 10 years. Unlike previous market peaks, today's baseline is dominated by massive, price-agnostic buyers like central banks and Tether, with the latter purchasing more gold last year than any single central bank. This aggressive institutional accumulation is a direct reaction to the weaponization of the US dollar and ongoing government profligacy. Consequently, global central bank foreign reserves held in dollars have drastically fallen from 78% in the year 2000 to approximately 48%. Because broad retail and generalist participation remains noticeably absent, the market has not yet reached the manic phase that typically signals a definitive top. Share your thoughts on this Eastern physical squeeze in the comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive precious metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.